COVID-19, presidential elections, stimulus, zero interest rates. What in the world is going on with the markets? Hey, it's Dean Barber, CEO of Barber Finance Group. Join me along with Bud Casper, President of our Lease Summit office, as we discuss the markets in this monthly economic update. Okay, Bud, here we are. As of the date of this recording, what are we, the 29th of July?
Yes, indeed.
And so we're just about through the hot month of the summer. It's been a hot month in the stock market. We've seen some good things happen, nice recoveries. And I think the big thing on people's minds today is, all right, what's causing the recovery to be so rapid? What is really driving the markets? And I think the confusing part to a lot of people, and quite honestly, it can be confusing to professionals like us that have, been doing this for 70 years combined, is that companies are having a hard time even providing guidance on what their earnings are going to be because the economy is still in such disarray from COVID-19.
No doubt. I mean, let's face it, some businesses are absolutely shattered. Now, you ask what is stimulating this economy at this particular time and how the market is reacting to that. That obviously is coming from the stimulus program coming in from the government, in addition to the Federal Reserve keeping the rates low, but more importantly, coming in and taking control, especially in the bond market, which was a critical situation, in my opinion. And I'll even make an even bolder statement that one event that occurred when the Federal Reserve finally came in and said we'd be the buyer of last resort of all bonds was, I think, perhaps the scariest information that I ever have come across in 38 years of doing this, because if the bond market were to collapse while the stock market was doing likewise, the insecurity associated with that could have been catastrophic, in my opinion.
Well, and so you and I were talking just before we sat down to record this, that when we go back to the Great Recession of 2008, and when we headed into 2009, things still looked bad. There was still an awful lot of uncertainty, and yet the market rebounded aggressively in 2009 after its March 9th lows. Mm-hmm. And the reason that it rebounded aggressively was because of the Federal Reserve, because
Absolutely.
of that zero interest rate policy and that commitment to continue to keep that interest rate low. And you had the quantitative easing, which was really a stimulus.
True.
Right? And so, the term "don't fight the Fed" was really coined and became very, very true. And so I'm of the opinion that even though there's so much uncertainty with corporate earnings and people really don't know, what's going to be next, when are we going to get back to full employment, when are we going to get back to the consumer being able to go out and spend and do what they normally do? We don't know that yet, right? Will there be a vaccine this fall? Will there be a vaccine in the spring? Will there ever be a vaccine? We don't know the answers to those questions. But what we do know is that we have the support of the Federal Reserve, and we have the support of the United States Congress and President.
Right.
I believe that the market believes that the government will do anything necessary in order to keep the economy going and in order to keep the markets propped up, whether it be the stock market or the bond market. And I think it was evident when we started seeing these multi-trillion-dollar stimulus packages come out. The stock market just takes off, and it has continued. So let's really take a look here at what's gone on.
Let me add one thing to your comment on that, and that is coming into the 2009 period, March 9th, as you noted, was the low point. We didn't see a sudden surge back into the stock market. It took the entire summer for confidence to come back in with what you just suggested from the Federal Reserve program.
What we're looking at is the different indexes on a year-to-date basis. Mm-hmm. And so we have such disparity in where returns are and where returns are not. So if we're looking at this chart and we look down here at this red line, this is the S&P 600 small cap. Mm-hmm. And so we can see that small caps are still down on the year 16%. Right? That's huge. Now,
no reward there.
Let's jump up to the S&P 500. S&P 500 is basically a flat line, right? It is down by 0.21 right now. All right. So what's this one up here at the top? I don't think it's any surprise. It's the NASDAQ composite, right?
Right.
The NASDAQ composite is actually higher by 20%. So what's that selling? we've got a 37% differential between small caps and technology, or the NASDAQ, so far this year in 7 months.
Yeah.
What's that tell us?
Well, I think we have a situation here where the 5 big companies in technology are driving the returns, both for the S&P 500 and obviously for the tech sector itself. And so with that being said, it really does explain what we are experiencing at this point, and I think it's going to also tell the tale into the future. If you look at it right now, look at the S&P 500, 26% of the return of the S&P is based on technology, and specifically those 5 companies that
Amazon,
we're talking
Microsoft,
about.
Facebook.
Right.
That's a big deal. Now that's happened before.
Right.
It happened in 1999. Okay, just before the dot-com bubble. And so, what are people saying today? Well, if I'm gonna make money, I gotta own big tech, right?
Right.
And right now, it's true. Go back to 1998 and 1999, bud. And I know we got to stretch back a long time. That's 21, 22 years ago. But what people were saying back then was, you know what? The old style brick and mortars, value companies, forget about them. Everything now is going to be technology. And when the tech wreck happened, we saw technology drop by 70% within a 2-year period.
Versus 47% for the S&P for the exact same period.
Right. But what did well in 2000 and 2001?
Bonds.
Bonds and financial stocks, right? And high dividend paying stocks,
right?
So the good old value did really, really well. So the point to that is, don't get to a position where you're always just chasing the performance. Don't forget about asset allocation. Don't forget about diversification. And sometimes you might feel like you're missing something, but if you want to make sure that you're smoothing out your ride as much as possible in the equities market, you still have to have that diversification, bud.
Yeah, and I think it's, from a historical perspective, if you think of the 20s, 30s, and 40s, Dean, what was the way we judged performance in the stock market? The Dow Jones Industrial Average. Why? Because we were a manufacturing economy at that time. In 1957, Standard & Poor's came in and said, that's not a fair way of looking at the market today. And so what they did is they divided the market up into 11 different sectors, and they filled each of those sectors up with stocks that best represented the sector. And that was actually a very good way of truly measuring what the broad-based market was doing. But if I were to tell you that technology today represents 26% of the S&P 500's return, what does that tell you? S&P has been biasing the portfolio to technology. Why would they do that? They are going in, and at that point, they are seeing all this money that's coming into pension plans, IRA accounts, individual accounts that are investing in the S&P 500. And if that were to perform equal weighted, you wouldn't get the returns that you're getting out of the S&P 500 today.
Well, here's why. Take a look at this.
Okay.
Take a look at this. Here's your different sectors, bud. So we're going to go down here, and we're going to start up at the top with information technology. Year to date, plus 15.21. You can scroll on down here. You got 4 sectors that are in positive territory. You get to the S&P 500, not really one of the sectors. It's kind of the benchmark there, and that's the one that's flat. Okay, so what do we've got? Consumer staples, negative. Materials, negative. Utilities, negative. Real estate, negative. Industrials, negative. Financials, negative. And all the way down at the bottom here, shouldn't be a surprise, is energy, negative 38%. So here you have a 53% variation between the best sector and the worst sector in the S&P 500. Now, the average of all those sectors as they're weighted inside of the S&P 500 give us that flat return for the year, but you can see how the tendency is going to want to be to overweight up here in the technology area, because that's where really the money is being made. Right. And so I think the question that we have to ask is a question that we're always asking: is the market overvalued? Is it undervalued? Is it fairly valued? And I would encourage everybody to get out and get to our website, barberfinancialgroup.com, and check out the blog post that my brother Shane, one of the partners here at Barber Financial Group, wrote on market valuations. It is very detailed, very in-depth. We're going to go over just one slide out of that particular article, but really get out there and read through this. It might confuse you a little bit because there's a lot of technical information in there, but you'll come away with a clear conclusion, and that is that the markets today are indeed overvalued?
From the perspective of earnings and everything, and Shane did a great job in that article, and I encourage everybody to go out and read it. When we look at this moving forward, though, what concerns do we have? Well, obviously the coronavirus is number one, but number two is going to be the election and what possible consequences that could bring to the stock market once a decision has been made one way or the other. So what should an investor do? You should stay in tune. Okay.
But again, so it's going to go back to this whole concept, Bud. When we do financial planning using our guided retirement system, what we try to do is we say, let's not take on any unnecessary risk.
Mm-hmm.
In other words, so don't get greedy. Don't take on more risk than what your portfolio needs in order for you to be able to meet your financial objectives. Let's take a look at this valuation chart. This one particular chart compares 4 different measurements of valuation. It's the Crestmont PE from its geometric mean, the cyclical PE, and then and this is actually the Shiller cyclical PE here.
CAPE ratio.
Yeah, and then the Q ratio, and then the S&P 500 from its regression. So the best valuation that you get here is the CAPE ratio, the cyclical PE 10, which shows the market is now 88% overvalued. And as you can come back here and see, this is down at the bottom here, you've got the years. Okay, so 2000, here's 2008. So here's your 08 time frame, kind of right in this area here. Right. And then if you take a look, this was the .com bubble up here, right? Mm-hmm. And here's where we are today with these different valuations.
Yeah,
so
looks rather similar, doesn't it?
And that's right. And that's what we're talking about, the similarity. Now, just because those valuations are there today doesn't necessarily mean that they come crashing down, right? There's 2 different ways that those valuations can get lower. We can get better earnings, and that brings those valuations down. Right.
And for that to happen, the economy's got to recharge.
We've got to get that economy recharged. And I think we've seen this surge in the valuations because corporate earnings have fallen off a cliff, right?
Yes.
And so as the economy recovers, the bet, and you can see it happening in the market today, the bet is, like I said earlier, the Fed's coming in, Congress is coming in, we got stimulus, we got zero interest rates. They're not going to let this economy fail. They're going to keep it going for the good of the American public and for the good of the normal taxpayer that's out there trying to earn a living, right? When this does recover, I believe these price-to-earnings ratios will start coming down naturally. What we have to be cognizant of is that we may not get a vaccine in the fall. We may not get a vaccine in the spring, and this COVID deal could leak on for another 18 to 24 months. If it does, I don't think there's any way that these valuations can hold up for that period of time.
I agree. I agree wholeheartedly with that. In the interim period, the stimulus is so great that it's going to probably hold up the market, would be my guess. So I think we're going to have kind of flat returns, if you will, getting close to the election. And I think after that point, Katie bar the door. I don't know what's going to happen at that particular point.
I think what happens after that, Bud, is going to depend on 2 things: who wins the election and how soon we get a vaccine.
Right.
Yep.
Right. So
until then, you and I and all of our advisors here at Barber Finance Group are looking at this stuff every single day. We're keeping an eye on your portfolios. I want to encourage you to share this information with your friends. Share the video. Give us a like out there on YouTube. Follow us on Facebook, and stay in tune with all the different things that we put out. We've got a lot of great content that we write every week and a lot of great videos that we put out. We appreciate you being part of Barber Financial Group. If you're not a client of Barber Financial Group and you'd like an opportunity to visit with one of our advisors, give us a call or send us an email and let us know that you'd like to visit. We'll set up a no obligation visit, and it can be done by phone. We can do a Zoom meeting, or you can come in person. Like Bud and I are sitting here next to each other today. We're actually doing in-office meetings. Hope everybody stays healthy and stay safe. Thanks for taking the time to join us today. Bud, thank you for taking time to join me here for the monthly economic update. All of you YouTube viewers, make sure to give us a thumbs up and subscribe to our YouTube channel, and also share it with your friends.